Good morning, everybody. Welcome to the Flow Show. Fed Day, the big man Powell set to reveal all, tell us what we're doing wrong and what they're doing right, and hopefully giving us some volatility to trade as well. Are you all locked and loaded, K-Man?
Locked, yeah. Loaded. Good morning, mate. Good morning, everybody. No, loaded, actually not. I'm going into the second part of the week on a cautious, with a cautious mood, you know. I don't have much running in the dollars right now. Although the obvious side would still be to panic and be long dollars in massive long dollars, but I don't know. It's a bit too much. Well, perhaps not too much, but I don't know whether this worrying mood or panicky even mood on if you look at the bonds and the equities are justified or not. So I am having the cautious approach and will more react than front run into the second part of this week.
Yeah, very much. I think, and we saw a good example of that yesterday, which I'll talk about shortly, of why you can't pick a side for more than 5 minutes between data points, because we had a two-way reaction yesterday. As I said, we'll get to that in a moment. Right, let's crack off with some of the headlines. China, and this was sort of comments around this July plenum meeting that they're going to have. The Politburo has vowed to step up support for the economy. So one of the things they'll be discussing in depth at this meeting later in the year. Over in Japan, we got the Ministry of Finance intervention report, which, no surprises, showed no intervention between March 28th and April 25th. So they didn't include, obviously, Monday's lot. Couldn't even include anything up to Friday. So, yeah, as Candace said, we will have to wait until the end of May before we find out exactly how much they intervened. That hasn't stopped a few people digging and picking, shall we say, through the bones of the Bank of Japan's accounts stuff that they post each month. The press got stuck into it. Someone got stuck into it and said that BOJ data suggested that they may have spent some 5.5 trillion yen for that intervention on Monday. And they're drawing that conclusion from, as I say, these accounts that the BOJ produce monthly that says that their current account was expected to drop by I think it was 2.6 trillion, but it might actually drop by 7.5 or 7.6 trillion. And the difference between obviously those two numbers is some 5 trillion, which they're assuming is going to be what they intervened with. Who knows? I have no bloody idea whether that's true or not. It seems strange that they would give away such an easy clue when Candace trying to keep it under his hat for another month. But it might be right, it might be not. I don't know enough about stuff like current accounts and what goes on in amongst the numbers to make a call either way. What are your thoughts on that, Kay? That will put it potentially round about the sort of numbers they may do. They did one of those of that size in that 2022 intervention period. Doesn't really matter anyway.
Plausible, very plausible. And I was already wondering when Canada said that they wouldn't produce their numbers before the end of May. I said, how can they keep it secret if the Bank of Japan produces data, because the Bank of Japan is doing the trades? So I think it's plausible, and yeah. Whether it's bang on the number or so, I don't know, because the initial expectations of that current account can be variable, but not to such a degree. So I think it's plausible. Whether it's 25 or 35 billion dollars equivalent doesn't really matter that much. Although if it would be really the 35, I find it a lot, especially on a holiday, seeing where they started to intervene. quite a big one, and it's perhaps a bit worrying, especially if we if we would get another strong U.S. jobs report on top of it at the end of the week. That would really put them in a pickle, I think. But yeah, I mean, just for the numbers, I think it's plausible, and yeah, that's not going to say,
Yeah.
but exactly. But sources, some sources say it is plausible indeed.
Yeah, as I say, it's certainly they did one similar amount in I think it was one of the October
Yeah,
interventions. 2022 was of the same amount. So yeah, it is in the ballpark. But again, it doesn't really matter. We know they've intervened. All bar getting a report at the end of May, we know they've intervened. But I guess it's just we keep an eye on these numbers just in case, if it cost them 10 trillion to do that intervention, then that's a lot of money, a lot more money for little reward. But then we have to remember what their objective is. Their objective isn't to trade data points. Their objective is to take speculation and volatility out of these moves. So we could get another run to 160 on the back of the NFP. But then the question is, well, that's dollar US related, not yen related per se. So that's not necessarily something that they would look to hit. It's all depends on ticking the boxes, as we're always fond of saying. What we also heard is,
straight away add on the
yeah,
US report, and people are speculating, and I was musing about it this morning as well. I said, imagine they intervene on Friday morning before the NFPs, and then the NFPs come out bad. Would they have the numbers? That would be thing. But the thing is as well, this speculation about them, and a lot of people I see say like, oh, they're waiting for the NFP to intervene again. It's not because the NFP will come out that they will intervene again. If that NFP is really strong and sends the dollar higher versus everything, they know that it's going to be a lost battle. They may come in just to show that they are serious about the speed of things. Let's say if we fly from, let's say we go into the NFP at 158 and it goes up to 161, 162 on Friday evening, they will probably intervene because of the speed of things. But there's very little that they will be able to do. Because waiting for the NFP is just pure speculation, really.
yeah,
I think we have to tell our audience that it's one of those things. I told you so. If they would, because of the speed, and but it's not something that they are really planning ahead of doing so. As we remember back in 22, they intervened, and then afterwards they got helped by the lower CPI in the US. They did not intervene into a lower US CPI. So imagine that we get a real bad NFP. Just imagine, and the dollar weakens overall. Don't expect them to intervene just to try and push dollar yen lower. That is not how they work. Well, that is not how they
yeah,
worked for the 40 years that I've been in the markets. They are not there to push things in the direction of the market if it goes their way. They are not speculators. It's not SNB. It's not any other central bank wouldn't do it either. To be fair, perhaps the one or the other emerging market may do it, but the Bank of Japan or the MOF rather are not going to intervene if the NFP puts dollar yen from 158 to 155, for instance, and try to
yeah,
push it under 150. That would be really a first in my 40 plus years career.
yeah. And we had the same conversation last week before the PCE. Everyone's saying, "Oh, PCE could get them to intervene." They don't trade data points. Okay, these guys don't trade data points. If you want to know what's going to cause intervention again, this is your clue here. This price action. Okay, when did we get that spike through 158 to 160? We got it in Asia, early hours of the morning. Japan shut. No other pair blinked an eyelid when we did this, except a tiny bit of sympathy move. We didn't see cable ramping higher or cratering. We saw no other moves except in the yen. Okay, that's your clue. So if we get a strong NFP Friday and the dollar's rallying and dollar yen's back at 160, but cable's down at 123, 122, euro dollar's down at 105, and it's all moving together, they're not going to intervene. If we get to Friday night, late hours of Friday night, like we did last Friday, and these aren't moving, cable, euro dollar's not moving, but yen is moving again, then that's showing you that the speculators are coming out and pushing the buttons again. And it should also be reminded there's another bank holiday, I think, Friday, in Japan, isn't it? But
absolutely, Friday and Monday.
Friday and Mondays. But as we saw this Monday, they will be there watching.
Oh, yeah.
You know. So, yeah, you know what to look for now in intervention. If you weren't around in 2022 or can't remember what happened then, well, here it is exactly what happens and how they do it. So no one should be caught out by this. Watch the yen. If it's moving and nothing else is moving, then that's getting into the intervention realms or speculative realm. So you should be ready for that. Right, so I was going to say one thing. Our mate, our most favourite propeller head, Brad Setzer, was out in Bloomberg talking about Japan and the intervention. And he says that the huge FX gains are a benefit to Japan from intervention. He says reserves are unhedged foreign currency assets, and the accounting of reserves is always complex, but there are clear financial gains. And it just so happens that some of the biggest windfall gains are sitting on the government balance sheet. So if they're making good money on the intervention, that quashes one of the things that a lot of people like to throw at intervention, that it's a waste of money. It hasn't done anything meaningful. Well, if they're making money from it, they don't give monkeys about it. It's not their main focus, but it just means that they keep their ammo chest loaded up and indeed maybe even getting bigger. So it's not always a negative just because they spent a load of money that they're not going to make anything on the back of it. Right, let's have a look at some of the data. And where am I? Let's go back to this morning. What have we got this morning? New Zealand. That's where I wanted to start. We got some jobs data out from New Zealand. The employment change was down 0.2%. Labour costs year on year down a little bit softer, 3.8%. Labour costs on the quarter as expectations, but down from last quarter. There was quite a steep drop in the participation rate in Q1, 71.5%. Now, normal situations, you would expect the unemployment rate to go down on such a number, but it actually went up as expected, 4.3%. So a little bit of a weaker jobs numbers there from New Zealand. It's a holiday in a lot of countries, as you can see there today, Labour Day. So many countries off. That's why it's been a bit quiet this morning. But other countries are open, like us here in the UK. As you can see there, it's not a holiday here. Hence why me and K-Man are sitting here at our desks. But we had some final PMIs in manufacturing coming out. As you can see there for Aussie, a little bit softer, coming in at 49.6, but still an improvement over last month. We also had from the UK manufacturing, the final manufacturing PMI, which was a little bit better. Didn't quite turn around the move into contraction that we saw this month, but it beat the flash number 48.7 to 49.1. So the lesser of two evils, shall we say, a little improvement on that front. In the ECB, we've had ECB's DeCoste saying that they should start cutting rates in June if inflation continues to slow down as expected. But given the high uncertainty, ECB will follow a data-dependent approach where decisions will be taken at each meeting. Hawke Holtzman is back. He's back. He said the ECB shouldn't cut in both June and July. He'd given his tentative thumbs up to a rate cut in June, but he's being adamant that they shouldn't necessarily follow up with a quick cut in July. ECB's Vilroy says ECB can start to cut rates early June, but rate reductions from then on will be pragmatic. Yesterday's data in the US couple of bits and pieces. And again, this is what's going to show you why you can't marry a position for longer than 5 minutes. First out, we got the employment cost numbers for Q1. All the numbers were higher. Benefits 1.1% versus 0.7. The overall cost index beat expectations 1.2. Wages, that came in unchanged, although that prior month was revised up from 0.9%. So that was still a positive number there. So this is one of the measures that the Fed look at. Powell's mentioned it before in prior FOMCs. And again, it's looking sticky and it's not going down. So that's, if they had little confidence on these numbers last month, they've got even less confident on this month. So that's going to factor in. So that gave the dollar a little shot in the arm. House prices came out as well, all looking fairly strong still there too, despite murmurs that the housing market is facing problems. Yellen came out yesterday to say it's becoming very difficult for new home buyers or first-time home buyers to get into the market. Well, those high prices is one of the reasons why. But then we moved on to consumer confidence, and that came in at a stinky 97, and the dollar went the other way. That was really quite a big miss on that one. Current conditions falling a chunk as well to 142.9 versus 151 previously. Expectations 66.4 versus 73.8, and that all important CPI expectations, 1 year CPI coming in unchanged at 5.3%, quite a high number there too. But on the back of that, so we've had higher wage costs, and now we've got lower US consumer confidence numbers. So it's two things for the Fed to consider in that. And the dollar, as I said, went the other way on that one. What did you pick out from that data, mate? What's going to be important for the FOMC or for Powell?
Yeah, sticky. There's not too much else to say. I mean, quickly on the housing, it's again an issue of supply apparently, and not like overly high demand. But it's apparently the supply of houses has been extremely low over the past period here, and that's what drove prices up again. So it's again that balance between demand and supply, which seems a bit distorted again. To put those price hikes and into perspective. Yeah, we still see when inflation remains sticky that it's the inverse correlation with the consumer happiness index. It's still there. And we've seen exactly the same in Germany, by the way. When they were expecting hikes to come, all of a sudden the German consumer was a lot more happy. For the rest, yeah, the employment cost index. Although we have seen those little yellowy flags, employment-wise, that index picking up again is perhaps still a bit worrying, and that is likely one of the data points that is going to push the FOMC to remain a bit more hawkish than what may be expected until last week or so. And we've seen it in the bond market, in the equity markets. Overnight, everything was very quiet, and then all of a sudden, yesterday, after that cost index and that inflation expectation, it all of a sudden went a little bit, I'm not going to say panicky, but twos are well back above 5%, tens are back at 470. The S&P lost how much? 100 points or so. Yeah, it all went a little bit in an acceleration there.
Yeah, very much. And yeah, we're going to be looking at yields in a little bit as well, because that's looking a little bit bulgy at the moment on that front, on the yield front. So yeah, that's the US data side of things. Anyway, we did also get some Canadian GDP for February, monthly numbers for February. Not that anyone's paying too much attention to that anyway, but it was a point softer than expected. Where we going there? Month of February, and also the preliminary March estimation, let's call it that, coming in flat. So touch weaker data there, which might get Macklem talking a little bit more dovish when he next pops up. I think he's popping up this week sometime, if I'm not mistaken. I did mean to see it somewhere that he's squawking at some point this week, I think. Can't remember when. I have to look at it.
Tonight.
What's
Tonight,
that?
tonight, him and Rogers, they were jealous that Powell got to speak today, so they wanted to be a part of the party as well. But they speak after the
There we
Fed
go.
press conference.
Okay. We've got him speaking this afternoon.
No, you
Same
are
time as
on.
ADP.
No,
Is
you
that
are on. I don't know what timing your calendar is on, but you're for sure not on the European one.
oh
You're
oh
close.
no? Then he's speaking again there tonight.
Oh, you got them speaking as well earlier today. Oh,
Yeah,
yeah. All right. Okay. Yeah.
yeah. We'll have to check it out. I'm not sure I trust this
Yeah.
this calendar that much, but yeah, we'll check that out just in case. Just in case he's speaking twice, so we'll make sure. But that's coming out bang on ADP time. So that's obviously going to have the market looking closely. Not that it really means anything, the ADP numbers, but still, if it's a big variation, it will get the market moving around, no doubt. Anyway, right, and then we do have ISM as well coming in at 3 o'clock our time. So, not the biggest sector, but still an important sector. So we need to keep an eye on that because might get the market having a little last minute flutter for NFP and for power tonight, and also jobs as well. So all these little indications, all these little metrics coming in that might just have a little bit more influence than they normally do, given that we got power tonight. Not that it should make too much difference to what they do. I forgot what I was going to say now. I think that's in the data front. You got anything else, Kay?
Yeah, regarding the McClem thing, I've got them for tonight on the Bank of Canada website, but I've got them for tomorrow around that time that our calendar shows. It is only on for tomorrow, it seems. I'm just putting the Bank of Canada link in there for people to look at. They don't have him for today at the early in our afternoon around ADP time, just that. Anything else? What else have I been reading? No, nothing really. Yeah, it seems that Japan may introduce tax break also to spur some Japanese yen repatriation. But yeah, that would make some of the companies happy now. The issue is always when they repatriate money, where do they park it? And if they park it in JGBs, that's not going to help the yields higher either. So I'm not sure if that's really. It may impact the FX a little bit, but anyway the exporters already do, and the exporters are not waiting for tax breaks to repatriate profits. They have actually been, the bigger exporters have been reporting record profits because of the weakness of the yen, because of the Nikkei and topics going up. So I mean, it's already the case. I'm not sure whether tax breaks are going to help anything more, because on the other hand, if your home currency weakens, you're less likely to produce in your home country. So all those big exporters, they also have a lot of their production lines elsewhere, like the big car makers or the heavy machinery guys, Komatsu and everything. They have stuff elsewhere as well. So I'm not sure if that's going to have like a big immediate impact anyway. And for the rest, no, it's been quiet on the relatively quiet on the other news front, let's say.
Yeah, thank you very much, mate. So, right, let's get stuck into what we're expecting from the FOMC later today. Obviously, the main event coming up. Just a quick brief. I did put a little thing in the room earlier. I know K-Man has done as well. It's always difficult. I'm as guilty as other people of going into these things expecting Powell to give a strong message on one thing or another based on what's happened. And as we've said before here, he's shown time and time again he does a good job of walking that middle line, giving information and views when needed, but not doing so that's going to get the market getting too out of its pram. So I think we're set for the same sort of thing again. He has got some the pressure is rising on this confidence for rate cuts, because with every passing data point and month and whatever, inflation, the employment cost, that sort of thing, is still not going their way. And you know, it's the old how long's a piece of string before they have to really change their tack and be worried about it. So I think the broad thing from here, the market is doing its usual thing and getting probably a little bit too hawkish going in. You know, we can see that probably from this move in yields at the moment. You know, it's just pushing the envelope, I think, on getting towards too extremely hawkish going in. So it's all going to be, if Powell walks his middle line and doesn't give the market a really hawkish message, then obviously we're going to see that unwind. But I think the broad gist of it is, and I keep coming back to it, that line that he said with Macklem, that it's appropriate for rates to leave rates where they are and let them do their thing for a longer period of time. I think that's going to be the key in the message later on. It's just a question as whether the market sees further reduction in the Fed reducing their rate expectations, i.e. the dots, at the next meeting. So we've got a market that may be a little bit too hawkish going in. And if Powell disappoints by not playing up to that, we'd probably see a reversal in the dollar and yields. But I wouldn't think that's going to reverse too far, because we're still in the same situation where this data is still improving and inflation is still sticky. It doesn't change the overall picture. What we do have, though, is that we we slam into big data points, ISM and NFP on Friday. If we get a less dovish Powell and then a crappy NFP, all these gains in yields and the dollar are going to evaporate pretty quickly, because the market will all run to the other side of the boat and start pricing up cuts again. But you have to look at it all in context. We need a trend in jobs, a weaker trend in jobs, not just one print. And it's unlikely that one print is going to show a huge change. You know, you're not going to see, hardly going to see unemployment jumping from whatever it is, 3.8% to 5% or something like that. It can happen, but that'll be more of a shock move than anything else. So we need to see a trend, okay? And the Fed have got two mandates: prices and employment. If they're not seeing a trend in employment, they will still continue to be more concerned with inflation. So even if the jobs market does turn, if inflation's still sticky and maybe even going up, that will be their main concern over jobs. On the other side, they've already told us that they're happy to cut into a strong jobs market, but that relies on inflation doing what they want it to do. And they haven't got the confidence. They've got even less confidence than they had last meeting in March. So it's really, like Kay said, it's going to be reacting, you know, knowing what the market, which way the market's leaning going in, a bit hawkish, and matching that up with what Powell says. That'll get you your initial reaction, post-Fed or whatever. It may last for a session or two. Then you come back to the fundamentals and we know what they're doing. Sticky inflation, strong jobs market, economy not doing too bad. So I don't think any sell-off in yields or the dollar is going to be lasting, at least until the NFP on Friday. Kay, what are your thoughts?
Well, you covered both your and my thoughts.
Sorry, mate. But we're on the same line broadly, so
I mean,
you know.
Yeah, what more can I say? I mean, you really covered both of it. well, listen, I think that okay, where I'm going to diverge, because I mean, always having the same view is not funny either. Where I'm going to diverge is that I think the jobs are going to take over from inflation, and I've been saying it for a while. I've also heard what I wanted to hear from Powell exactly, where we said that they are going to look at the second bit of their mandate. So I think the NFPs could really cement or destroy a lot what's going to happen after this FOMC. I think Powell has to be hawkish. He can't be otherwise, because I mean the data are there. Unless he wants to hide behind weaker consumer sentiment, or which would be the dovish surprise, but we know that they are planning to relax QT a little bit second part of the year as well, unless he lays out like a really detailed plan, because they find the financial conditions have been tightening too much about relaxing QT. That would be a bit of a dovish slant. But yeah, just to counterbalance where he needs to be hawkish. But again, I also said that I think the market is perhaps expecting a bit too much. The pendulum is swinging again. We are now pricing basically in very, very close to only one cut. But I think for more pricing, it will depend on the jobs report on Friday. If we get another report that defies the laws of gravity, I think we may actually completely price out the rate cut for this year in the market, and that would send the dollar to where it hurts, I think, against some currencies at least. But yeah, my base case is that he's still going to walk both sides of the aisle. I'm still of the thought that he will only hike if it's really, really, really necessary. He also said as much over his past couple of chats. So perhaps, yeah, my feeling is that the market is going a little bit hot into the FOMC tonight. And I've also been reading the articles that are being published in the media saying that market is going like in with the heaviest short bond positions or via options and biggest short options on long options on risk to the downside, as well in the equity markets. I find it a bit hot, but that leaves the door open for the surprise trade being not as hawkish as people may fear in the end. So as I said in the room, I'm traveling extremely light. Yeah, the side is still for a higher dollar. Then it would become a wrecking ball affair again, and you can't fight that one. But to me, there is this outright little chance that finally the jobs reports are starting to come more in line, because they have been really hot as well. Start to come more in line, and then we can have like perhaps a couple of reports that start to show weakness. I do think though that if we get a weak NFP, and that's where I'm going to diverge, I think it's going to be enough to have the pendulum swing to the other side, and the dollar get a really serious knock on the head on Friday. But again, I will react rather than front run all of these.
Yeah, I note, and I'm just going to put the link up. I know your NFP guess is missing a 1 this month. Is that reflecting your instead of 111, you've just gone for 11? Is that a typo, or that's your view on like you're saying about the jobs market?
I'm in panic mode.
Well, I've just put the link up for anyone wants to have a crack at the non-farm payrolls competition.
Yeah,
that's up and running. That's in the Zoom chat there. So let me ask you this question, and just trying to look forward a bit. We know they don't want to hike. They really don't want to have to hike again. They want to get rates down. You know, rates at near 5.5% isn't good in any way, shape, or form. What happened? You know, they've had inflation being sticky now for 10 months, not getting below 3%, creeping up again. What happens if the jobs market doesn't turn and inflation stays sticky and, you know, maybe creeps up to 4%, just above 4%? How long can they really hold off not turning more hawkish?
Yeah, I think then uh, that's a good question. I thought really, you know, my base case and for this year was like a Q1 dollar rebound, Q2 bit of a mess, and then Q3 second half of this year we are going to see clear. In that scenario, it will probably have to wait a bit longer to see really clear. But in the meantime, it could really end up being the end of this quarter again, being a bit of a dollar wrecking ball affair. Yeah, because it seems like the ECB is now baked in. Bank of Japan is not going fast enough. SMB are rather on the cutting side, which they may hold off as well if really things in the US, because everybody's looking at the US in the end, remains much more sticky. And Bank of England is like a weather vane. We flip of the coin. Yeah, then I really fear that the dollar is going to go for another leg and another serious leg and hurt a few currencies, especially the funders, and perhaps also some emerging market countries who rely on rates not going too much higher and who are really dying for rates overall and their dollar debt interest rates to come down. So if they don't get that, I think then we may be in for a period of serious pain and a much higher dollar. And if you ask me what the Fed is going to do, that's Dickie Matthews' scenario, right? They will have to hike, and that is going to be, yeah, the worst thing that well, the worst thing that can happen. I mean, we will trade it as it comes. We are traders, but that's going to be the real dollar wrecking ball scenario if they really are forced to hike.
Yeah, and that would be another credibility issue because
Well,
they've hiked this far and it hasn't worked. So
mm,
having to go again is a bit of a will be seen as a bit of a failure. And then we'll probably get the US start squawking about dollar strength because, you know, there's limits for them as well as to how strong the dollar gets.
yeah, and let's not forget.
Well,
Yeah, and let's not forget that both the ECB and Bank of England have already started to mention the stress on the currency if inflation doesn't come down, and and they were really looking at effect. Well, really looking at effects. They were keeping an eye on effects to see the impact, and they were hinting at the US inflation, right? So
yeah,
yeah. Do you know when we were talking about the Japanese intervention? There's nothing in the other currencies or in the whole situation right now, the global situation, that is calling for any accord like we had the Plaza, the Louvre, and a few other accords.
yeah,
If though we would get a discontinuous strong US economy, strong labor market, strong, very, very sticky inflation, whether it be supply or demand. I mean, and it's rather going to be supply driven again, I guess. But if you really get this wrecking ball scenario setting in, then perhaps take us 3-6 months down the line into autumn. Then perhaps, you know, we will have to think about start to think about such a scenario. But I would not really want to go in such kind of scenario before we really have all of this in place, you know.
yeah.
But it is something that we have to be ready for every eventuality. But this should in theory still be at least 4 or 5 months away from now.
Yeah, exactly. I think that's the point. You know, it's everyone trades the now. Everyone trades, you know, whatever's happening in prices now. But you know, you need to think of these things. Just keep them in the back of your mind. Even if they never come to pass, you should always be thinking, what is the risk moving forward for anything? Because then, if you start seeing signs, you know that you may have to react to that with your trading in the short term. because of what may happen in the longer term. But anyway, that's for a few months ahead, and I agree with everything that K-Man's saying on that front. Right, let's go for a little wander around the prices. I'm in the same boat as K-Man. I'm traveling very light. I've got nothing on in any dollars bar dollar yuan. All I've got is euro sterling, and I'm dabbling a little bit of oil as well as me dollar yuan. Dollar yen, it put to bed what was ever happening at 157 yesterday, and it's not stopped going higher since. So we're back on the creep with this one. Not quite the volatility we saw in this move from 155, but it's grinding higher again. Levels really not anything you can really trust. I've just put a couple of lines on there that were just basically the price action that happened in that time. So, it's not anything you're going to hang your hat on. But we're above this area and holding it at the moment. 157.80s called it. Then it's going to be into the big figure. Then we had a little bit of action around about 158.5. So it's going to be a bit difficult to trade this one again. I'm still loath to trade this one at all. I might have another look at 160 because we know it's a big old historical level. And that'd be probably the only reason I look to have a go at it. As for the rest, it's all about doing your homework for today and the Fed picking your levels. If you're trading euro dollar, you don't want to be getting caught around in the middle here going into the FOMC. So set your stall a bit wider. 106 is a level, 60 pips away. Might be a bit close for big Fed news. My level, 105. That's the big one I'll be watching. And anything from here up into the high 107s towards that 108 zone, and maybe even that 108.30 zone on big news. If we get big news, it has to be game changing to bust out some of these ranges. Just being a little bit hawkish doesn't necessarily mean we're going to go all the way to parity. You'll probably hear some squawkers going on about that. So take the news in context. If we do get dollar strength, look to see if it does break out. If we get down to 105 and it doesn't bust through, well, then there's a bit of stuff going on there. Maybe that's a bit of a stretch point. But if we do break it, you want to see the break hold. If it doesn't hold, if it goes down to a similar level, 104.5, for example, and comes right back above 105, then maybe we've just had a little bit of a flush move. The market just changing its tack a little bit. And as always, what I'm going to say, Gav, let's see where we close the week as well, because we could get strong dollar over the Fed and then a stinky NFP, and we go from 105 back to 107, and who knows where we end up. So just pick your levels, do it for whatever you're trading. Doesn't matter. Whatever you're trading, if you're trading the dollar, just pick your levels, give yourself, 100 pips either side before you start thinking about things, and just decide where you want to trade if the market moves that way. I think, as we said, yields are really going to be important these 2 years. As I'm saying, it's wiping out further the two-cut rhetoric that we've got. So where are we going to finish after Powell? If we're going to finish above 5%, he's likely been less dovish. Then we're going to be motoring probably higher. That's going to be an influence for the dollar as well. But even if he is dovish or less dovish, a bit hawkish, and we can't make gains in yields, maybe we come back under 5%, then that's going to limit what the dollar does. So have this chart open for yields, be it this one or 10s, over the Fed, and keep an eye on that before you look to trade the dollar. Get a bit of confirmation from here what's happening in the bond market in that sense. As for the rest, gold, having a little bit. Well, any headlines behind this move, Kay? We're breaking through the 2300. Got this gone through just the 20. Well, had gone through the 2390. Any news behind this move in metals, or are we just jockeying around with a big stuff to come?
Well, what I said yesterday on F.A.C.E as well. I've been noticing for for months now that they seem to have end of month stuff as well in the metals, and so we printed the low. Well, actually, we printed the low this morning on a bit of continuation, I think. But we went through this 23, 2025 on gold, and So technically, few people perhaps leaving the ship. Then a bit of month-end stuff and a bit of dollar fears on the other hand, heading to the FOMC. And now we are stabilizing. I think, yeah, your 22.65 there is a decent enough level as well to monitor post FOMC, for instance. If we get back above, I think 2300 is just a round number, right? It's nothing more than that, in my opinion. It's really that 2025 again. If we get back above there, then this was just month-end stuff, a bit of dollar fears, and then we pick up the baton again. Now, the big question is, because we know who is behind all those purchases, like China, Russia, other central banks, Asian central banks, even Korea admitted that they wanted to have more gold. So it all depends if those people decide to come back. May have to wait even until after Golden Week. I don't know if they if some of them observe holidays as well. I think some of them are. And then we'll see where we are. For the time being, I'm not overly tempted. I did say yesterday that I was, depending on where we were at 4 p.m., buy a little bit of silver. I did, but I really was running a very, very small position before, because I loved that a lot. So I bought it right on the fix in the 2630s. Now my next level is in the 25s. And that's it. Just follow the plan and go with it, and then see where we end up on the dollar at the end of the week. See if we need to increase the holdings or just be very patient. But I think in a nutshell, that's what happened on the metals yesterday as well. The dollar and the end of month.
Yeah, and as Duresh says, yeah, Middle East also a little bit calmer. But that can always spring up at some point. Yeah, I mean, the gold's been similar to S&P and the break it had, and we've had a decent, half decent move off the highs, but we haven't tested any big levels yet. This is, for all intents and purposes, just a little correction, a little pullback. So until it does start busting through the real support levels or the other support levels, then yeah, it hasn't changed anything when you look at the chart on that basis, a longer term chart. And the same looking for oil as well. We've been down testing this 80.50 level. This was the basis of me having a little nibble down here. I started a bit high and I've added down into this level just because it's been a point and we've held it as support a few times. So I'm having a little feeler that we might do again. We'll see. Maybe if we get a soggy ISM later on, that's going to do for oil for the demand side of the picture. But yeah, here we are, a bit of support, and we'll see what happens there. But it's challenging, this trend. But again, looking a bit like a bit of a pullback at the moment. But below that 80.50 area and holding below that, things might start to look a little bit weaker. Kay, do you want to show us your magic for anything?
I'm looking at the clock.
I'm
going to go very fast over stuff. By the way, Derek, yeah, makes me think that apparently, let me just quickly look at who it is. But there's this. Is it the French Prime Minister, or who is going to Cairo? So it seems like the French really want to make something about the Middle East situation. So I'm not sure if they are going to have a breakthrough, but the French want to be involved in everything, of course. But sorry for the Frenchies, but I'm Belgian, so I'm allowed to laugh at you guys, because you have enough at us. So yeah,
yeah, 4 minutes.
Maybe that has to do as well with a little bit of the attitude towards a bit more calm situation in the Middle East. But again, the underlying is still There's still a lot of smoke, I'm going to say. So quickly on that cable, which is, so yesterday I spoke about those two levels here, yeah? Mid 125s up to 125.65, and then the 123.60, 124.65. This is where we landed. A bit against my assumption because it was relatively quiet until the fixing time, and it's only after the fixing that cable really continued its move. I guess it's all about the dollar yesterday evening, right? We saw the S&P come off, we saw the yields rise, we saw and we saw the dollar move up against most currencies. By the way, we are going to have U.S. Treasuries details out today as well. Their funding details should be out, so could be sending a bit of a wobble through those yields as well, depending whether they are going to prioritize the short or the longer end of the bond market. Okay, so I visit 8:30 Eastern time could be anyway this afternoon for us somewhere. So these are the levels that I'm going to watch: 124.5, 124.40. If we start to confirm under 124.40, there may be a bit more to run here into the mid 123s. That is in case Powell really gives into to the hawkish pressures. We could even reach down into those 123.30s again. This is really a possibility. If in turn he's where I would expect him to be, or where I think he may be, we may actually try just below on an algo move or so, and then go back above. Don't forget that Powell does during his pressures usually start one side and then drifts over to the other side. So don't forget that we will see, or we should see, some pendulum swings tonight. Yeah, he does do that, and he starts one way of the spectrum, and then he moves gradually over to the other side. So don't get married to his first line in the press conference. Okay. So that for the cable, dollar yen is a bit of a useless one to look at. I think we're back at that 158, which I had, but it's just like extension level. I really wouldn't. I'm not going to do anything in dollar yen before Friday. Let's put it that way. I want to see the NFPs. If the NFPs tell me that that everything is still same and strong, then I guess this is going back to where it may hurt, and perhaps like a late Friday spurt, which I may accompany. But anyway, if we see bad stuff, then your first big marker is going to be 155, and the point of no return is 152 to me. Still, if we get back below 152 in a natural way, below there, then I think we're in for a reversal, but much too early to call, of course. I just want to show the Swissy because, as I've been saying, when there was this risk of interventions, I was actually hoping for the Swiss to strengthen a little bit, and then start to take over part of the role of the yen as a funding currency, because when you can sell less yen, you have to. The carry traders are always looking for the second best currency, and that, in my opinion, is the Swiss franc. So we saw this little rally. Well, we saw the rally now continue in the Euro Swiss. We've also seen a bit of shoots coming out of Europe. So I think this move is still there to continue, but. And Mark showed a very nice picture as well. We are around another bit of a trend line here in the Euro Swiss right now. But I think so. These prior highs, early April, June 2023, are to be monitored in Euro Swiss, and then we will be closing in on the 50% of the. This is when S&P started to say it's okay for the Swiss franc to strengthen, and we are closing in on the 50% of that move. I think that's going to be an interesting one to monitor. Okay, and that may, in fact, as well. I'm not saying that S&P will comment, but if we get above, are we going to get some kind of comment from the S&P saying like, okay, this is enough. Now we are going back in two-way mode. it is possible, okay? Because I also think that the S&P would not want the market to completely undo their work that they've done. But on the other hand, we've also seen the Swiss companies still remaining a bit on the weak side and on the defensive. So I do still think that we can continue. I do still think that we're going to see parity on the Euro Swiss, but pay a bit of attention to what's going to happen around here, okay? And then the dollar Swiss, we rallied through finally through the 91.5. There was some mixed expectations on the month end yesterday, but then finally we saw the Swiss sell-off into the fixing, and we are now comfortably, at least for now, holding above this 91. Call it 35.50. Okay, this is going to be your first support zone before 90.5 and call it 90.25, 90.5 here, but look where we are. We are closing in on where we started the 2023 year-end dump, okay, from. And also, we are not too far away from the whole of 2023 decline, and that's 92.35. And here, this high is 92.40 somewhere. So call it 35.45, 92.35.45. This is going to be an important next level on the dollar Swiss. Look where we are post FOMC, but I'd say especially post FP. If we get data that still are bullish dollars and we fly through here, this could be another accelerator for higher levels in the dollar Swiss. And then I think we're starting to talk slowly about high 94s into the 95 zone. And with that, Ryan, back over to you, mate.
Thank you very much, mate. Good stuff as always. Well, hopefully we've got you all set and ready for tonight's event at the FOMC. So do trade well, traders. Be safe. Don't hear any horror stories. And have a great day. And we'll both see you all tomorrow to find out what happened. Thank you very much.